All right, let's go ahead and get started then on a new topic today. On the financial system. All right. Sean, I'm going to pick on you today. You're going to be my example, okay? Let's suppose that Sean gets the bright idea of dropping out of college, okay? He's going to quit school, and he's going to go make money as a boxing trainer. He's going to give boxing lessons, okay? Sean, before you even give your first lesson, you're going to have a lot of items that you're probably going to need to purchase, right? Some of the more obvious ones. If you're going to give boxing lessons, you're probably going to need a bunch of punching bags, right? You'll need to buy a boxing ring. What else is in a boxing gym? Those huge jump ropes, those huge mirrors that go wall to wall, right? Lots of stuff. So, Sean or anybody, what type of goods are we describing here? What category of GDP are these particular items that we're talking about? Wyatt? These are investments in capital goods, right? These are goods that are not used, Sean, for your own end consumption, but they're used to produce boxing lessons, which is the final consumption service that you're providing. So these are physical capital goods that you're going to have to purchase up front, okay? Now, Sean, let's also imagine for a moment that you don't have enough cash on hand, you don't have enough savings, let's say, in order to purchase all of those items. These items collectively might cost, I don't know, $30,000, $40,000, $50,000, depending on how extravagant you want your boxing gym to be, okay? How might you go about obtaining those funds to purchase capital goods? Well, I can think of a couple ways. Sean, go ahead. You can get a loan, right? You can go get a commercial business loan from any bank in the area, right? The idea here is that you would borrow from that institution, right, with the promise to pay back the amount of the loan called the principal, plus some periodic interest payments over time, okay? That's certainly one way that Sean can finance the purchase of his capital or investment goods. Are there other ways? Matt? So you could, okay, so Matt says you could sell off part of your company. In other words, enter into a business partnership, right? Where in exchange for the funds, let's suppose, Matt, that you have $50,000 that you're willing to invest, right? You might be willing to provide that seed money to Sean in exchange for a share of his future profits. Maybe 10%, maybe 25%, whatever the case may be, okay? The point of this little hypothetical exercise here is to understand that regardless of which of these two methods of finance that Sean chooses, his investment in capital goods, the boxing ring, the mirrors, the jump ropes, etc., is ultimately being financed by someone else's saving, right? Now, in the second example, that's crystal clear. This $50,000 that Matt has, he's chosen not to use to buy consumption goods, right? In other words, that's part of his income that he has saved, and he hopes to earn some positive return on that in order to finance, Matt, your consumption in the future, all right? Your savings immediately becomes Sean's investment in capital equipment. What about the first example, where Sean drives up to a local retail bank and takes out a commercial business loan? How is it that in that case that someone or some group of individuals' savings becomes Sean's investment? Well, where does the bank get the money to provide the loan to Sean in the first place? What? From clients, that is people who are making deposits at the bank, right? people who are electing to save some portion of their income. And so in that first case, it's still true that some group of individuals' collective savings is ultimately being channeled here into someone else's investment, okay? This section of the course is all about the financial system, okay? Now, the financial system, we're just going to kind of loosely define here as the economy's group of institutions that helps match one person's or one group of persons' savings with another person or another group's investment expenditures on capital type goods, all right? Now, how to tie this in, part of this class is learning how to see kind of the big picture. And although we may go from one kind of disparate topic to the next, I want you guys to see how these things are actually linked in a broader idea, all right? You guys remember when we talked about the solo growth model, we use these terms saving and investment quite frequently. They were important, right? We showed that when an economy saves and invests a larger fraction of its output, then that helps grow the capital stock, which leads to higher productivity and higher incomes and higher living standards, right? So in that particular growth model, savings and investment was important for driving improvements in living standards in the long run. Yet, in that whole talk about the solo growth model, we were really silent. We didn't have much to say on how exactly the economy coordinates the actions of those individuals who are saving with those individuals who are making productive investment purchases, right? We just assumed that if society decides to save more dollars, that ultimately that will create a larger amount of investment, right? Savings goes up, investment goes up. We didn't talk about exactly how that process plays out. In reality, in the real world, savers and investors are usually different people. At any one point in time, there's going to be a bunch of us that have more income than we need for our own consumption. And we want to save some of that income and earn a higher return so that we can finance our future consumption. There's going to be another group of people, however, that don't have enough income to buy what they need. People like Sean, who need extra money to purchase things like capital or investment products, okay? What is it in our economy that ensures that the supply of savings is channeled to or is balanced by the demand for investment? There's got to be some type of coordinated effort in our economy that kind of balances those two forces, that makes sure the total dollars that are saved in our economy ultimately get kind of channeled to what people want to make investments in. That's, in a nutshell, what the financial system does. That's the critical role that the financial system performs in our economy. The whole point of the financial system is to channel resources away from savers to investors who have productive investment or capital opportunities, all right? Let me just give you a real quick outline of what we're going to do today and the next class. The first part of our talk today is going to be really just going over the various institutions in our economy that comprise the financial system. This is a broad term. There's lots of different types of financial institutions that make up our broader financial system. We're going to talk not about all of them, but about 3 or 4 of the major ones. We're then going to discuss the relationship between the financial system and some of these key macroeconomic variables that you guys have already seen in this course. GDP, consumption, investment, government spending, etc. How do the dollars that flow through the financial system relate to those aggregate macroeconomic variables? And then the last thing we're going to do, which we will not get to until next Monday, is we would ultimately like to develop a more formal or coherent model of the financial system. The model that we're going to develop is based on very straightforward supply and demand principles. That's why we reviewed supply and demand first thing in the semester, right? Because I told you we would apply those concepts or that model to different macroeconomic markets, all right? This is going to be a classic example of one. We want to develop a supply and demand model of the resources or the funds that are available in the financial system. Where does the supply of dollars come from? Where does the demand for dollars come from? But most importantly, what is it that adjusts in order to ensure that supply equals demand? It's probably going to be a price of some type, right? What is the price of investment here that we're talking about? I don't mean to spoil the surprise, but you're obviously going to be related to an interest rate, okay? So that's going to be a key variable that we'll look at. Only when we've written down this kind of formal model then can we analyze, for example, how certain types of government policies affect the financial system, how they affect our country's levels of savings or investment or interest rates. Okay. Any questions about that so far? All right, so again, the financial system is this group of institutions that matches savings of one person with the investment of another. We're going to broadly talk about two types of financial institutions today, all right? One is called financial markets, and the other is what we refer to as financial intermediaries. All right, let me focus on financial markets first. These are defined as institutions through which savers can directly provide funds to borrowers, all right? I'm underlining the word directly here because within a financial market, there is direct one-to-one interaction between the person who's doing the saving and then the person who's doing the investment, okay? This little example that we talked about at the start of class today, where Matt takes part ownership of Sean's boxing company, that would be an example of kind of a financial market interaction where there is one-to-one interaction between the saver and the investor. The two broad types of financial markets that we're going to talk about today are the bond market and the stock market. The bond market and the stock market. Okay, I cannot remember in the slides that I provide you guys what I've left as blank and you have to fill in. So if I start to go through these slides a little too quickly, just raise your hand and I can back up, okay? All right, let's start with the bond market first. First off, what exactly do we mean by a bond? What is a bond? A bond is defined as a certificate of indebtedness, okay, that specifies the debt obligations of the person or government or company that issues the bonds to the actual holder of the bond. You can think of it as an IOU, all right? All right, let's make sure everybody understands this. This is a principles class after all, okay? If you were to go out, let's say, Aaron, you were to go out and purchase a bond, okay? Is Aaron a lender or a borrower in that case? If Aaron uses her own money to purchase a bond, is she borrowing or is she lending? Matt? She's lending, right? So don't get confused by that. When you or any other investor goes out and purchases a bond, you're actually lending your money to the entity that issued that bond or that sold you that bond, okay? So whoever sells the bond initially is the group or the entity that is doing the borrowing, and they're going to pay back the amount of that bond plus interest to the holder of the bond at some point in the future, all right? So bond holders are lenders or creditors. Bond issuers are the borrowers. Let's not get confused about that point. As an example, let's suppose that Delta Airlines needs to finance the purchase of a fleet of new 757 jetliners, okay? Well, one way that it can finance the purchase or the construction of these is by selling bonds to the public. Let's say, $50 million worth of bonds. In that case, Delta Airlines is borrowing directly from the public through the sale of bonds. Companies are not the only groups that sell bonds, right? Obviously, governments do, not just the federal government, but state and local governments issue bonds. You can purchase bonds from foreign governments. You can purchase bonds from foreign companies. So lots of different entities issue bonds. Now, some markers of a bond that I think you guys should know. When you open up the Wall Street Journal or you go to any financial website and you try to look up some information about various bonds, there are God knows how many different types of bonds out there, probably thousands and thousands. There are three basic markers that help identify a bond, okay? One is its date of maturity. That, as it sounds, is going to be the date at which the original loan amount specified on the bond has to be repaid. Bonds have a variety of different maturity dates, which I'll talk about more here in a minute. The other marker of a bond, and probably the most important to investors, is going to be the yield. All right, this is the same thing as the interest rate. These interest rates are normally, if not always, quoted at an annualized rate. So even though you may only hold a bond for a few months before you sell it to someone else or before it matures, the interest rate on that bond is expressed as an annual rate. And then the third marker of the bond is, of course, the principal. This is the amount that is originally borrowed. Usually these are in $1,000 increments. I've seen some bonds, I think, in $10,000 increments as well. So the date of maturity, the yield, as well as the principal are the three main kind of markers of a bond. Now, bonds will also differ according to three other key characteristics that I want to spend some time talking about, okay? The first characteristic is a bond's term, all right? Now, what do we mean by the term of a bond? That's basically just the length of time until a bond matures. There are bonds that are sold to the public that have terms of a huge variety of different lengths, okay? For example, you can purchase a treasury bill from the United States Department of Treasury, the federal government, that has a term as short as 1 month. You can also buy treasury bonds that have a term as long as 30 years, okay? So there are long-term bonds, there are medium-term bonds, and there are very short-term bonds. Some countries, not the United States, still issue or still have traded, at least in markets, things called perpetuities. You guys know what that is? What do you imagine a perpetuity is? It sounds sort of like the root word perpetual, right? This is a bond that basically has an infinite term. It never matures, okay? So if you were to purchase a perpetuity, that bond, you would receive interest payments periodically for as long as you held it, or at least until you sold it to another investor. But the principal is never repaid on a perpetuity, right? It's paid forever. The US government doesn't issue bonds any longer of terms more than 30 years. Let me ask you a question. So I don't have this in the slides, but I think this is an important thing to understand. What do you imagine typically has a higher yield or a higher interest rate? Long-term bonds or short-term bonds? And remember, these interest rates are expressed at an annual rate, okay? So keeping those fixed, would you expect a bond that has a short term to have a higher or a lower yield than a bond that has a long term? Matt? Yes. So in general, what we tend to see is that bonds that have a longer term, a longer duration to maturity, are going to have higher yields. Now, Matt is correct in his assessment of this. It has to do with risk. The fact of the matter is that most long-term bonds are riskier investments than holding a short-term bond. The type of risk that Matt was pointing to here was inflation risk. That is certainly one. When you buy a long-term asset, if inflation's higher than expected, that's going to reduce the real return to your bond. That's one type of risk. There is another type of risk, however, Matt, that I think is probably even more relevant for this question, and it's what's called interest rate risk. Let me kind of describe what that means. Imagine, Matt, that you had two investment options. You could either, in option A, purchase a bond that has a term of 1 year, hold it until maturity, and then you get the principal and interest. Or alternatively, let's say you could purchase two consecutive 6-month bonds. And so after the first 6 months ends, you would just roll over the principal and interest into another 6-month bond and hold it until maturity. All else equal, we would expect the returns on those two different investment options to be about the same. There's no reason why purchasing two consecutive 6-month bonds should be less or more profitable than holding a 1-year bond until maturity. But in practice, the 1-year bond typically has a higher interest rate. Now, why is that the case? Well, Matt, imagine this happened to you. Let's say today you buy a 1-year bond, okay, and the annual yield is 3%. You wait 6 months, and something happens in the economy, and newly issued 6-month bonds are now going for a yield of, let's say, 4 or 5%. So something happens in the economy that causes interest rates to rise from when you first purchased your bond until 6 months later. You as a bondholder would like to take advantage of that higher yield, but you would have to sell your 1-year bond to another investor at a loss because your bond is no longer as attractive as the newly issued bonds, okay? To compensate investors for taking on that extra risk associated with holding an asset for a longer period, you have to typically pay those investors a somewhat higher yield. And so that's what we call interest rate risk. And it is in some ways related to inflation risk as well, but is one of the reasons why longer term interest rates are usually, not always, but usually higher than short-term interest rate. Let me take you guys, I'm going to show you real quick the Treasury Department's website just to illustrate my point here. So here is what the current Treasury yield curve looks like. What the yield curve is it shows all the different bonds of different terms that are sold by the Treasury Department and what the current annualized yield is on each of them. So the 1-month Treasury bill has a current annual yield of 0.09%. And you will see that as the term lengthens, the interest rates tend to go up all the way to the 30-year term that has an interest rate of 1.57% per year. So the yield curve is upward sloping. As the term to maturity increases, the annual yield rises. These are historically extremely low interest rates, by the way, okay? It is, in years past, it was not uncommon for these 10 and 20 and 30-year interest rates to be significantly higher, 3, 4, 5, 6%. But it's still, you can see, an upward sloping yield curve. The second characteristic of a bond that I want to briefly mention here is credit risk. So this is also important to understand. What is credit risk? That's just the probability that the borrower, the issuer of the bond, will default. What's default? Default is a situation where the bond issuer fails to pay all of the principal and the interest. Right? So if any part of the principal or the interest is not going to be paid, the issuer is said to be in default. Now, what do you think happens to the yields on bonds that have higher credit risks? Investors deem a particular company or a government to have a high credit risk. What do you think happens to the yield on those bonds? It's going to go up, right? And again, it's for the same reason that I just talked about a minute ago. Investors are risk averse. They're not going to want to buy risky assets unless you compensate them with a higher expected return or a higher yield, okay? How many of you guys have heard of junk bonds or speculative grade bonds? These are bonds issued by companies where investors think that there's a fairly high likelihood that those companies are going to go bankrupt and fail to repay all of the principal and interest. The interest rates that investors demand on those loans are going to be higher than the interest rates that investors demand from the US government, as an example. The last characteristic of a bond that I think you should know about is its tax treatment. How does our federal government treat interest income for tax purposes? It's treated just like wage and salary income, okay? So interest income on bonds is no different than regular wage and salary income, with one exception I want you to know about, and that is if you purchase a municipal bond. A municipal bond is a bond that's issued by a state or a local government, usually for like infrastructure type projects, libraries, schools, roads, etc. In order to encourage investors to buy those bonds so that local governments can fund those projects, the federal government gives it a favorable tax treatment. The interest that you earn on a muni bond is not going to be taxable at the federal level. Now, let me ask you one last question about this. Given the municipal bonds' favorable tax treatment, all else equal, what do you expect to see regarding the yields on municipal bond relative to some other bond? Do you think interest rates or yields on muni bonds are going to be higher or lower than average? What does your intuition tell you, Sean? Lower, but it's not necessarily as much as risk as it is the fact that the favorable tax treatment elevates the effective return on municipal bonds, right? Your effective return is the interest rate minus whatever is taken out due to taxes, basically, the tax rate, okay? Because the tax rate on municipal bonds is basically zero, that boosts the effective return, and so the actual yield tends to be lower on municipal bonds than it does on comparable other corporate or government bonds. Okay? So understand what a bond is, and understand in particular these characteristics, what a bond's term, its credit risk, and its tax treatment are. Okay, you guys have questions about that? Let's move to the second financial market that I want to talk about today, and that is the stock market. Another way for, let me continue my example from earlier, for let's say Delta Airlines to finance its spending on new 747s is instead of issuing bonds to the public, what it could do is it could issue or sell stock, okay? Now, as you guys know, stock entitles or represents ownership and a claim to the future profits of that firm, okay? So let's just ask kind of the obvious question first here. What is the fundamental difference between stocks and bonds? Matt? Exactly. When you purchase stock, you are becoming a part owner in the company that issues the stock. When you buy a bond issued by a company, that doesn't entitle you to any type of ownership stake. You are just a creditor of that company. So one is a creditor, one is actual part owner. okay? Selling stock to raise capital is what's referred to as equity finance. When companies sell bonds to raise capital, it is referred to as debt finance. Let me ask you this question. Which method of finance do you think the holder of that asset, either stock or bonds, is going to face that individual with higher risk? Which is riskier? All else equal, purchasing stocks or bonds? Sean, why do you say that? That's right. So the return to stock is very much tied to the performance of that company in the economy, right? If the company has high earnings, your stock returns are going to be high. If the company has low earnings, your stock returns are going to be low, maybe even negative. So there's much greater risk with equity finance. Now, if you were to buy junk bonds, Sean, perhaps that's going to be more risky. But if we do a apples to apples comparison here, generally equity finance is riskier. Which method of finance do you think offers the creditor with a higher average return? What's your name? Say again. Okay, Graham, go ahead. Stock, right? Stock is going to offer the investor a higher average return. This goes to the point of a basic principle in finance. There is a trade-off between risk and expected return, right? The investments that have the highest expected return are typically also going to be the investments that are riskier. In other words, the only way to lower the risk associated with an asset or an investment is to accept a lower expected return. There is a trade-off between those two things. And equity finance has higher risk, but therefore it also has higher expected returns. What else do I want to say about the stock market? Okay, I think you guys should know, and I'm not going to take this for granted that you do know this because it is a principles class after all. You probably need to know the difference between a primary market and a secondary market. When you guys think of the quote unquote stock market, in particular, trades that are organized on these big stock exchanges like the New York Stock Exchange or the NASDAQ, those are actually secondary stock markets, meaning that the trades are occurring between different investors, okay? When someone purchases stock in a secondary market, let's say on the New York Stock Exchange, the company that originally issued that stock is not actually receiving any money for that trade. The company that issues the stock only receives funding in a primary market, sometimes referred to as an initial public offering. That's when a corporation first goes public. That is a primary market sale of stock, right? The vast majority of stock sales occur on these secondary markets, on these big stock exchanges like the New York Stock Exchange or the NASDAQ. So make sure you know the difference between those. When stocks are originally sold by the companies, they're in primary markets called IPOs, all right? All of these other stock trades that we hear about all the time, the vast majority of them occur in these secondary markets. Bonds are the same way, by the way. When the federal government first issues bonds, it is done in what's called a treasury auction. But after that, investors can sell bonds between one another in secondary markets. Okay, any questions about that so far? All right, I think an essential skill that any graduate of a macro principles course should take with them is the ability to really read and interpret a stock table. All right, you're almost certainly going to have to use this knowledge or at least come across this information throughout your life as you think about how you want to organize your portfolio and get ready for retirement, okay? So that's what I actually want to spend the next several minutes doing, is going and looking at an actual stock table and then looking at some important information that the stock table provides that can help you think about how best to make decisions regarding what different types of stocks you might want to buy, okay? There are, I think, three main items that you want to pay attention to when deciding how to allocate your portfolio of assets with regards to stock, okay? One is the obvious one, the price. That is the share price. That's the price of a single share of a company's stock. Another really important one, however, particularly for those who want to invest long-term and hold stock because those equities can provide a source of income to you in the future. Those are called dividends, right? Dividends are the share of profits that are paid out to stockholders on a quarterly basis, all right? This is critical information when thinking about what stocks to buy. Not all stocks issue dividends. Some companies issue higher dividends than others. And a third one that I think is important when trying to determine whether or not a stock is either over or undervalued, right, is the PE ratio. That's the share price divided by the earnings per share. There's lots of places like Bloomberg you can go and look at stock tables. Right before class, I went up and looked at Yahoo Finance. And so that's what I'm going to look at today, and we'll do this together. Where is it? Oh, here it is. I don't know how to work the internet. Sorry. Okay, so this is the company that I'm going to pick today, Walmart. Everyone knows about Walmart. All right, a stock table has a lot of information in it. The first thing you notice, this big number here in the left corner, is the current share price. So Walmart is currently trading. Actually, the trading day has closed now. It closes at 4 p.m. Eastern time. So it was $141.36 was the price of a single share of Walmart stock. The stock table also shows a lot of other interesting information. So like at the beginning of the trading day today, Walmart opened at $141.51 a share. The day's trading range was between $141.12 and as high as $142.09. So there was some spread between the low and the high there. This shows the 52-week range, 102 to about 151. I think this graph is kind of interesting because it kind of shows in real time how the stock price fluctuated over the course of the trading day between, I guess, what is that, 9:30 Eastern time all the way till 4 o'clock. And usually these websites also allow you to lengthen the horizon. So like if you want to look at the last 5 years of Walmart stock, you can clearly see that shares in Walmart have grown significantly over the past 5 years, right? 5 years ago, you could have bought Walmart stock for what, $50 a share, something like that. It's almost triple that value by now. What else do we see in the stock table? I think this one's interesting. So this is the volume. This is the number of shares that are traded in a single day. This is the average volume. So it looks to me like the total number of trades today was considerably lower than the average over however many past years. So the average daily volume is around 10 million, but it was closer to 4 million today. Okay. Now, to relate this back to what was on our slide, so there's a lot of information here, but when you're deciding about which stocks you might want to have in your portfolio, the share price, of course, is important, but I also talked about the dividend as well as the PE ratio, all right? You'll notice that this stock table here shows you this thing called the forward dividend as well as the dividend yield, okay? The dividend is $2.16 per share, and the yield is 1.53%. All right, let me write that down because what I want to do is actually show you guys some calculations on how you can get the dividend from the dividend yield, etc. All right, so the share price was what, 141.36. What's the dividend yield today? It's 1.53%. And the PE ratio is currently 22.55. All right, now let me go over any, was there a question? I thought I saw a hand raised. No, let me go over now to the document camera here. I want to do some quick calculations based on the information that is in the stock table. So the first thing that I'd like to calculate is the actual dividend. Now, this stock table on Yahoo Finance actually showed us what the dividend was, but some of them don't. Some of them only report the dividend yield. Others will report the dividend, but not the dividend yield. Let me be clear about what the differences are between those concepts. And by the way, guys might want to jot this down on your own notes because I don't have these calculations directly in the slides. So the dividend yield is defined as the dividend per share divided by the actual share price. All right, so in this example, Walmart had a dividend yield according to the table of 1.53%. That is 0.0153. What I want to do is try to figure out what the dividend actually is based on information about the dividend yield as well as the known share price, which was $141.36. Well, you can flip that simple equation around to actually solve for the dividend. And what do you get? 0.0153 times 0.0153 times, let's see, $141.36 gives us a dividend of 2.16. And so there will be a slight rounding error, but basically a dividend of $2.16. That's the dividend per share. So if you owned a share of Walmart stock, every quarter, Walmart would write you a check for $2.16, right? If you owned 1,000 shares in Walmart in your portfolio of investments, as a part owner of the Walmart company, you would get a dividend check in the amount of $2,160. That is really the primary reason why stockholders purchase stock long term, is to generate this stream of dividend payments for as long as they hold the stock, okay? If I told you what the dividend was, you could simply turn this equation around and actually find the dividend yield. Very straightforward. What about the PE ratio? So that was the other piece of information in the stock table I think you should know something about. What is that? The PE ratio is defined as the share price divided by earnings per share. It's the share price divided by the earnings of the company per share of outstanding stock. Okay. We know that the PE ratio is given in the stock table as 22.55. The share price was $141.36. What we don't know, what's not given in the table, is going to be earnings per share. Again, you can flip this equation around and figure out what earnings per share are. $141.36 divided by 22.55 gives us an earnings per share of $6 and roughly 27 cents. Okay, now how do we make sense out of that? Let's be careful about this. So according to the PE ratio, Walmart is telling us that their earnings per share as a company, that's profits divided by essentially the number of shares, is $6.27. The dividends that they're providing to their shareholders, however, is only $2.16 per share. Where is the rest of it going? Matt? Yes and no. It's called retained earnings, to be exact. A company's earnings are divided into two things. Walmart has some amount of profits that it earns every quarter. It's going to give some of it to the shareholders in the form of dividends. The rest of the pie it keeps for itself to reinvest into the company. To the extent those reinvestments might boost the share price, you could be correct. But to be exact, retained earnings would be earnings per share minus the dividend, right? And so what are retained earnings in this case? $6.27 minus $2.16. What is that? $4.11. So $6.27 in essentially profits per share. Walmart gives $2.16 per share to the shareholders. It keeps the other $4.11 to reinvest back into the company, or to keep the company liquid, let's say, to pay day-to-day costs and things like that. Let me ask you another quick question about this idea of a PE ratio. And, oops. I'll even go back to the stock table here real quick. A lot of times investors regard the PE ratio as providing information about whether or not a stock is over or undervalued. Let's think about this for a moment. If the PE ratio is really high, what does that tell us about the price of the stock relative to its earnings? That the price is high relative to the company's actual earnings. A lot of investors regard that as a signal that the stock may be overvalued, that it's too expensive relative to the company's actual earnings. Okay? So a high PE ratio can sometimes signal an overvalued stock. Yahoo Finance here has this nice little thing here which indicates, I guess, if you read that Walmart stock might be considered overvalued right now. As an investor, you want to stay away from overvalued stocks because their prices are likely to decline in the future, right? You would like to buy something that's undervalued. A lower PE ratio, where the price is low relative to earnings, would suggest that the stock is undervalued. But let me provide you a word of caution, okay? And I'm not a money manager by any stretch of the imagination, okay? But I do want to provide a word of caution here. Stock markets are very much forward thinking. The price of stock today really doesn't depend on what the company is doing today or yesterday, but rather what investors think the company's outlook is for the future. So if the price is high relative to today's earnings, what that could signal is that investors think earnings are going to be higher in the future, which causes prices to be bid up today. So don't always take a high PE ratio as a clear-cut signal that a stock is overvalued. It could be closer to fairly valued. You never know. Likewise, a low PE ratio doesn't necessarily mean a stock is undervalued. It could be that investors think the earnings of that company are going to be lower in the future, and so the stock price is lower today. Investors are always forward-thinking. These prices depend on their expectations of where the economy is going, not where it's been or where it really is currently. Okay? You guys have any questions then about that? So make sure you understand the basic elements of the stock table, okay? Difference between share price and the PE ratio and the dividend yield. I may very well ask you on an exam, give you some simple information to calculate some of those types of things. All right, with the time that I have left today, let me move on and now talk about the second type of financial institution that I mentioned in the introduction, and that is financial intermediaries, okay? Start off with a definition. So financial intermediaries are institutions through which savers can indirectly provide funds to borrowers. The definition of a financial intermediary is fundamentally no different than that of a financial market, with the exception of one word: indirectly rather than direct. Right? So with a financial intermediary, we're emphasizing here the role that these institutions play at kind of standing between savers and borrowers, acting as a middleman to help facilitate the transaction. Okay? There are two types of financial intermediaries I want to discuss. One, probably the most important in our economy, are going to be commercial banks. The other one is a mutual fund. Okay? Sean, let me go back to the example we used at the start of class today. You've got a small business. You're not Delta Airlines. So you're not going to likely be able to issue bonds in order to finance your enterprise. You're going to have to go to a commercial bank to take out a loan, okay? Let's suppose that the bank charges you 6% interest on your business loan. How is it that a bank turns a profit in the real world? So Sean, banks are going to charge you a certain interest rate on your loan, but banks also pay interest to people who are saving and making deposits at the bank. The difference is that the interest rate that banks charge for loans is going to be higher than the interest rate that banks will pay depositors. The spread between the two is how banks turn a profit, okay? So let's suppose that Wyatt deposits his $50,000 in a bank account, and the bank agrees to pay Wyatt 2% on those deposits. The bank then turns around and provides a loan to you in the amount of $50,000 at an interest rate of 6%. The bank pockets the difference between a 4% interest, right? Well, let's think about this for a second. Wouldn't it make more sense for you guys to get together and agree to an interest rate of, let's say, 4%? That's a higher return on your savings, Wyatt, and it's also a lower cost, Sean, for your borrowing. If you cut out the middleman there, it seems like both parties are going to make more money, are going to be better off. Well, what role is it that commercial banks are actually playing in our economy that still makes it profitable for society? In the real world, this little example that I've mentioned here is not likely to happen. It's very difficult for investors to find suitable partners to work with, okay? Oftentimes, you would have to spend a lot of time and resources trying to find suitable business partners in the economy. Furthermore, after Wyatt has loaned the $50,000 to Sean, that's a lot of money. He's going to want to make sure that Sean is making wise investment choices. And so you're going to want to monitor his activities ex post, right? So there's a lot of kind of search and monitoring costs that go along in the absence of banks, right? That's really one of the big things that banks do in our economy, is they simply break down a lot of those kinds of search and monitoring costs that go along with finding business partners in the economy, okay? That's one of the key roles of financial intermediation. Really quickly, one other significant thing that banks do is they also create an asset called a medium of exchange. This is also really important because this particular type of asset, which we're going to talk much more about later in the semester, enables us to actually buy goods and services with. It facilitates transactions. What's the key medium of exchange that banks create? Checkable deposits. When you guys deposit your money with the bank, you get a debit card and you can conduct transactions by just swiping that debit card, right? That is an asset there that the bank has created that makes it easier for you guys to acquire goods and services. So that's the other key role that commercial banks play in our economy. This one distinguishes it greatly from that of the bond or the stock market. You cannot go into the grocery store with your portfolio of stocks and bonds and buy anything, right? Those assets are not perfectly liquid. You can only do that if you have a medium of exchange. Banks provide access to that type of asset. What about mutual funds? So this is the second financial intermediary that I want to talk about. What are mutual funds? These are institutions that actually sell shares to the public, and then they use the proceeds to buy a portfolio of different stocks and bonds. I'm sure you guys have seen the commercials before, right? Usually there's like an elderly couple walking on the beach and there's a sunset, and then someone will say, either some voice, you'll hear T. Rowe Price or Franklin Templeton or something like that. Those are mutual fund companies, okay? What do I want you to know about these? What's the advantage? Why is it that people buy mutual funds? What's really the purpose of them? Matt? Exactly. The word you're searching for there is diversification, I think, okay? Most people want to be able to diversify their assets. Why is that? It's the old adage, don't put all your eggs in one basket. If you only have $10,000 to save, it's not going to be a wise decision for you to purchase $10,000 worth of a single stock. If that stock does poorly, your returns are horrible, right? You would rather diversify your savings among a lot of different assets so that if any one or few assets does poorly, you're not likely to lose everything. Okay, that's what mutual funds allow investors, even with not a whole lot of money, to automatically diversify. Right? It's difficult to diversify if you're buying stocks yourself unless you have tens of thousands or hundreds of thousands of dollars. If you don't have that kind of money, it's much more straightforward to buy a mutual fund, and then the company takes those resources, combines it with all of the other shares that it sells, and buys a whole big portfolio of diversified stocks.
You'll see. That's dope. Oh, no, you get really mad. Let me go on my run first.
No. Stay here. Stay.
Yeah,
How do I do this again? Make people be quiet.
Nothing bad.
You all, do I hit yes now?
Okay.
I love Zoom. Okay, you guys have any questions then about that? All right, so let me move on to the next topic here. What we've established today is that we've talked about the various types of financial institutions that comprise the financial system that help coordinate savings and investment, which I think is critical for the performance of our economy, for economic growth, as I talked about before. Certainly economists need to understand how these financial institutions work, okay? Ultimately, what we're going to do in the next class is build a model of the financial system so that we can use it to analyze how different types of government policies affect things like savings and investment and interest rates. But before we do that, I think it's important that we review some of these key macroeconomic variables that measure activity in our country's financial system, all right? So there's two sides of the national ledger here. There's savings and investment. Let me start with the savings side first. There's two types of savings that economists recognize that you need to know. One is private savings. What is that? Private savings is just a portion of households' income that is not used for consumption or paying taxes. So at the aggregate level, that's simply equal to our national income or our real GDP minus whatever we pay the government in taxes, I'll denote T, minus private household consumption. Now, just to be clear here, this T variable, that's going to be taxes net of transfers. This recognizes the fact that not only are we paying taxes to the government, but many of us are also receiving transfer payments from the government. So whatever our collective taxes are, after we've netted out all of those transfer payments, is given by this variable T. So this is private savings. You can also think of it as our nation's disposable income, output or income minus taxes, after we spend on consumption. Whatever is left over from disposable income minus consumption is what we refer to as the private sector savings. The other source of saving in our economy is public saving, or sometimes it's called government saving. This is basically tax revenue minus government spending, okay? If public saving is, well, let me go on to the next. So public saving is the total amount of taxes that are collected by the government, net of transfers, minus what it spends on goods and services, so T minus G. Let me talk for a few minutes now about public saving in particular. I think private saving is straightforward, but this idea of the public or the government saving may be kind of foreign to you. Normally, when we talk about public saving, the discussion centers around what we call budget surpluses or deficits. That's essentially the same thing as public saving, okay? So when the government is running a budget surplus, this is a case in which there is an excess of tax revenue over government spending, all right? So in that case, T minus G is a positive number. If the government collects more in taxes, net of transfers, than it spends on goods and services, then the government is saving a positive amount of resources. Public saving is greater than zero. That is the same thing as saying that the government is running a budget surplus. That, of course, almost never happens in this country, right? You guys are much more used to seeing a budget deficit. That's the exact opposite situation, where there is a shortfall of tax revenue from government spending. In that case, public saving is going to be negative, right? But most of the time, we just refer to the budget deficit as a positive number. So just recognize that. The budget deficit is really defined as government spending minus taxes. It's just it's going to be when public saving is a negative number, okay? Not to confuse anybody with that. You guys know the difference between the debt and the deficit? So public savings reflects whether or not a country is running a budget surplus or a deficit. What is the difference between the U.S. budget deficit versus the U.S. debt? Anybody know? John? Exactly. An individual's deficit is what that person's consumption is above his or her income. If you spend more this year than you earn in income, you're going to run a deficit, a personal deficit, right? Your debt is the accumulation or the sum of your deficits over time, all right? The same concept applies to the to all levels of government as well. I know I'm switching back and forth a lot today. another website I think is pretty fascinating called the U.S. debt clock, which shows in real time what the U.S. national debt is. So here it is. Our current U.S. national debt, or U.S. government debt, that number is what? That's $27 trillion. And you see how quickly it's rising. It's rising by tens of thousands of dollars, like per second. On a per citizen basis, our national debt is $81,000. If you simply divide the national debt by the actual number of taxpayers, though, it's over $200,000. Now, that doesn't mean we owe that. The government owes that. But that just gives you a sense of how astronomical the numbers are. Right down here, this box here shows the U.S. federal budget deficit. And as you can see, it is what, 3 trillion and rising rather quickly. So the annual budget deficit this year is around $3 trillion. The total U.S. national government debt is around $27 trillion. I think this row is pretty interesting. Okay, that just died. In 1960, the debt to GDP ratio was about 50%. In 1980, it had fallen to about 35%. By 2000, it was up again over 50%. And now our debt to GDP ratio is well above 100%. So the United States is definitely becoming a more indebted nation. Just to give you some more staggering numbers here. This entry shows the U.S. total debt. Now, what is that? That's going to be all of the debt held by the government at the federal, state, and local level, all consumer debt, all student loan debt, all credit card debt, every type of debt held by citizens and the government of the United States. The total indebtedness of the U.S. economy is $82 trillion, which I'm sure is more debt than any country has ever experienced, ever, anywhere. Wyatt? I don't know. Countries that have experienced, I'll just say this, countries that have experienced high levels of debt to GDP ratios where it kind of grows uncontrollably, will run into what's called a debt crisis, where they will default on their government debt obligations. When that happens, what do you imagine is going to happen to interest rates in this economy? If the U.S. government debt is no longer perfectly risk-free, then you can imagine interest rates on U.S. government bonds are going to skyrocket, which can be extremely destructive for an economy, right? The cost of credit goes way up. We could have a huge recession. It's difficult to say, but you can look at different countries over time to see what has happened there when they've gone into these debt crises. I'm not saying that's necessarily going to happen in the U.S. I certainly hope not, but we are definitely moving in a direction now into territory that we've never experienced, with debt to GDP ratios of well over 100%. There was a time right after World War II where the debt to GDP ratio got really high, like close to 100%, I believe, but we've now, I think, exceeded that level. I'm not making any predictions about what is going to happen to the economy. What I want you to do is be aware of how large these numbers are. The U.S. federal debt is not just a few trillion dollars, it's closer to $30 trillion. The deficit is about $3 trillion. Okay, I'm out of time, so we will stop there and finish the rest of this material on Monday.